Markets were tanking prior to this sham of a budget deal, whatever you want to call it. So who's leading whom? What's leading what?
Well, in the very short run, it's hard to tell the push and pull. But what we're coming at is a Fed that finally resolutely has shut down its printing presses. It will be selling its debt, shrinking its balance sheet.
But what's the surprise in any of that? That was expected, well telegraphed. What said it all?
Because the market is basically run by speculators and robo-machines who trade hour to hour, and it takes like...
And that's making this worse. That's making it worse.
It makes it worse, but it takes a large-sized 2x4 between the eyes before, the mules in this market wake up. But
well, the reason why I want to pounce on it, if you don't mind, is that the 10% drop we've seen is historically one of the fastest on record because of these boutique exotic investments, whatever you call these algorithms. Do you worry that that gets ahead of itself here and it actually accelerates all this stuff to the point where we're in a bear market within a matter of days?
You've just heard the beginning of this VIX thing that blew up. Right. 6 years. It took it to go from $16 to $200 in one day. It went back down 90%. That's just the tip of the iceberg. When you have speculation for 9 years running, when you have the Fed flooding the market with liquidity, when you have a Yellen put, a Bernanke put, you unleash the speculative juices like you can't imagine.
But now that the central bank is out of that business, we're told. Do you think it's going to be back in that business?
No, I don't think it is.
So that's the reality we haven't appreciated yet.
Yeah, I don't think we've appreciated that reality because this time they're out of dry powder. Remember, last time in 2008, they were at a 6% interest rate. Right. They had a long way to go. Back in 2000, they were at a 6.5% interest rate. They went down to 1%. Right now, they're stuck on the zero bound practically. They got this horrendous massive balance sheet that they're trying to shrink. And so when we hit the wall this time, and we will, because interest rates are going to soar. We heard this morning.
What soar to you?
It's going to go to 3 to 4% on the 10-year, which you may think is not much.
No, I know what you're saying. That's a big adjustment.
Because it's relative to where the market has been for several years.
Now, does the money that goes to that go at the expense of people leaving stocks?
Who knows where it'll go? Part of it will disappear. There's a huge amount of leverage and margin speculation in the economy. When asset prices start to go down, margin gets liquidated. It doesn't go into some other basket.
So is that what you think is contributing to an escalation in the sell-off? Just when we think we're done, we were up a few hundred points. Now we're down almost 400 points. Is that what's going on?
Well, but there's still the residual impulse to buy the dip is still there. If you look at a stock chart, it's been going up from 670 in March 2009 all the way, to 2680 or 2850. I mean, where it finally ended up. And there are dips.
So you think it's just a matter of time before we get to down 20% from our highs?
Oh, easily.
And then to what? Then what do you see happening with this particular market?
Well, when the market really starts to fold, it will ricochet into the real economy. Confidence in the corporate C-suite will be lost. Those guys just got their gift of a corporate rate of 21%. They'll start unloading inventory, unloading excess labor, doing anything that they can.
So even though their earnings look good, their forecasts and their guidance looks good, you think that's short-lived?
Yeah, because everybody in early 2008 said the stock market, all the great pickers of Wall Street said the stock market is going to end the year, at 1,700. It ended the year at 900. Okay, they all said earnings are going to keep growing. The market never.
You're right. Every time the argument is that the fundamentals are sound. You've been arguing the fundamentals are not sound.
They're rotten. They're rotten. When you're borrowing 6% of GDP in the 10th year of recovery, not the bottom, not the first or second year, the 10th year. Second, when you have a demographic time bomb hitting the 2020s, 30 million people are going to retire. They're going to bulge Social Security, Medicare. When you have a defense...
So is that the hitting point, or is that just the continuation point?
Well, no, I'm saying with that coming, the idea that you would run a deficit this big at the 11th hour of this cycle is utterly crazy, irresponsible beyond belief, and is going to sink us as we go.
But you blame the president on down?
Yeah, absolutely.
Everybody.
He has no clue. Donald Trump has no clue whatsoever. But I would blame, in the end, Paul Ryan for betraying what was left of the fiscal conservative opposition. They're gone. Right now, control has switched to the swamp creatures, to the McConnells, to the Democrats, to the
Well, caps, as you and I talked in the past, were like a backup spending backbone. If they couldn't agree to cuts, at least these were automatic ones, and they were never instituted. They always found ways around it.
But Neil, they did. They actually held things down to some substantial degree.
But they wiggled around them.
No, but they're going up.
6 out of 7 Congresses they wiggled around.
They wiggled around, but not much. Now they're going up $150 billion in one fell swoop per year, and they'll never come back. Now, I want to tell you, you're heading for a guaranteed $2 trillion a year deficit by 2027 if we don't have a recession. And do you think we're going to go 219 months without a recession? It's never happened in human history. So you lay a recession on that. You lay a political crisis on that. You lay downgrades of our credit substantially, which already have been announced this morning on that, and you've got a fiscal calamity. It's not going to stop. And last night was kind of the fulcrum point. It was a night of fiscal infamy.
All right. On that happy note, David Stockman, you can accept or reject what he's saying. We always like to get that view out.